Last episode, Jung spoke about the 5 worst areas of Melbourne. Today, I'm going to unpack the 3 metrics you need to understand before you invest in any suburb in Melbourne. And stick around to the end, because I'll even be sharing 5 specific suburbs, whilst also helping you understand vacancy rates, lower quartile pricing, and the importance of avoiding units, no matter how tempting they might seem. This information is so valuable for anyone looking to invest in Melbourne. I'm Arjun Paliwal, CEO of InvestorKit. Let's get into it. So the first trend I'm going to start off with in terms of data points is relating to avoiding units. Now, I know it might sound simple where someone goes, hey, yeah, don't buy a unit, buy a house. But you'd be surprised, especially with how many there are out there, how many there are being sold and rented, of course, that people go and make these investment decisions. I'm in the business actually not of property investing to help investors grow a portfolio, but of late I've realized I'm actually in the business of fixing broken portfolios. And the biggest thing that comes up is this. It's buying units in particular in Melbourne, right? So I'm going to go through a few data points just to share what in Melbourne is standing out. And the 2 suburbs I've got here are Melbourne CBD and South Bank. So the first thing to recognize is based on our data, they're quite affordable. The Melbourne CBD has a unit price of around $540,000. And the Melbourne CBD extending out to South Bank now has a unit price of $593,000 as a median. Now, in terms of these 2 areas, you'd think that they've done well or they've done okay, being Melbourne, a major city, overseas migration, big population, shiny buildings, great CBD, restaurants, foodies, cafes, all the good stuff that everyone talks about when they think an area is good. Well, in fact, these areas, Melbourne CBD up 4.33%, and then South Bank up 8.78%. Now you might be wondering, Arjun, well, that's great. Well, that's over 10 years. Pretty crap. Now, there is thoughts and data though that when an area hasn't done well over 10 years, it's going to return, but it's not that simple because returning to averages is one metric, but there has to be pressure around it that changes something. There's got to be a sign of life coming up that makes that change. Let's go deeper into some of the data to see if that sign of life is there or showing. Now, the first part of life coming up in Melbourne units is affordability. So the good news is that's there, but that's just one sign. The second sign, though, is actually around days on market, the time it takes to sell. Well, the CBD in Melbourne is up 6.98% over the last year, meaning it's taking 7% longer to sell a property. And the suburb of South Bank is up 32%, meaning it's taking 32% longer. It's almost a third on top of what it took the year before to sell a property. Right? So that's a huge amount of time of an increase. And now we go to the next metric, which is inventory levels. So this is the ratio of how many listings are there in comparison to how many sales are occurring. And for those new to this metric, if you had 30 listings in a suburb and you had 10 monthly average sales, that would represent 3 months of stock, meaning if no new listings came on, in about 3 months, all the stock would be taken. That represents a pretty balanced market. But over here, we've got Melbourne CBD with 5.4 months of inventory, and South Bank at 6.8 months of inventory. So definitely oversupplied from established listings for sale. Now we go to vacancy rate thinking, hey, I got a great apartment. It's in the CBD. It's cheap. It's fancy. The lift, the gym, the sauna, the rooftop. Like this is, Gary Bricker, his dream property, right? With all the health facilities and everything like that. You'd think that this is perfect. Well, vacancy rates in Melbourne CBD, 3.59%. And then vacancy rates at South Bank at about 2.91%. And if you're wondering what a balanced market is, it's about that 1.75 to 2% vacancy rate mark. Some suburbs you could say 1.5, but that 1.75 to 2 is balanced. Over here, in terms of the 1-year change of that vacancy rate, Melbourne CBD up 11.62 and then South Bank up 13.9%. So clearly, you can see in 2 major markets of Melbourne for unit prices, the only thing that's going well for it is that it's affordable and hasn't grown much. But you shouldn't use that metric alone. Too many people go through that mistake of thinking that they've timed the market perfectly and that everything's going to run back up just because it was cheap and a great price to get in. I don't think that's the case unless pressure changes or is showing some change, because right now it's not, it's still worsening. And to go deeper into the units of Melbourne, something you should clearly avoid, let's look at something we call incoming supply. Now, for those new to incoming supply, it's how many buildings there are currently in the area and how much is in approval coming through. Now, in isolation, I've studied this metric deeply. We've done correlation tests. We've run it back through many decades of review, and we don't see a clear correlation in isolation, meaning alone this data set doesn't move it. But if you have a triple whammy, which I call vacancy rates being up, established listings being up, and new supply being up, then where does that demand actually go into? It's just going into that oversupply. So it's not creating price pressure. In this particular case, let's look at the incoming supply of Melbourne CBD. So Melbourne CBD's current unit supply from data we could gather was around 27,000 units. There could be a little more in some areas that may not have flowed through to some of the data points, but let's just say there's 27,000 here. We've already seen around 7,700 new ones in the pipeline. So that means there's 28.26% of incoming unit supply. Ridiculous. Like, that's not a small amount of unit supplies. Now, you might think that, hey, Arjun, nationally supply trends are down, but there can be pockets where they're up. Now, in isolation, that's not a big issue, but if you look across the other points with established supply and vacancy rate that I took you through, it's clearly still an issue. So that just shows there's a fair bit of units coming soon. Some are not confirmed on completion date. Some are quite clear on completion date. So yes, approvals is one thing, starting off the ground and actually completing is another, and they don't always match with each other at the same time. But the key thing here is to recognize there is that vision, there is that thought to put a lot more apartments there, and a lot as a proportion of how much current supply there is. So that's the first trend, avoiding units. Let's jump into the second one. The second particular trend is called lower quartile pricing. So lower quartile pricing is a really interesting one, and it simply means this. If you took, say, a market of, say, $1 million in price point, and then that $1 million market or that city had 3 areas or 4 areas where sales could occur. Sales where there's under 500 sales, and there's a portion there. Then there might be, say, 5 to 750 and above. Now, that's not the exact quartile, but what I'm just trying to visualize to you is that if you divide the sales into brackets, those brackets of sales making up that overall price point is where you get different levels of activity. For example, there's blue chip markets or premium markets that represent the upper quartile of pricing, the priciest areas of a city, and they're obviously well above median prices in the city itself. And so that's kind of the upper quartile, and the lower quartile might be the lower socio, the outer rings, or the more affordable prices. Now, you can even have lower quartile pricing within a suburb because it's got its own median, it's got above that and below that. But the key thing here is to say it's affordable price trends across the city. Now, affordable can mean different things. Someone on $1 million a year might think a multi-million-dollar property is affordable to them in their suburb. So it's not affordability in terms of incomes. It's just affordability in terms of the lowest prices of that city. So that's the lower quartile. Now, with the lower quartile, something nationally has been occurring, and that's where over the last couple of years, since interest rates have increased, that price bracket of the lower quartile has been growing faster than markets in the upper price bracket, which simply means there's a trend line of, say, 3 lines, middle, upper, and lower, and that lower one is catching up to the middle and upper, and it's closing the gap. Now, this can do a few things. A, it can be great for upsizing markets in the future when people cash out of great growth in the lower tiers. B, it can make people consider upper and middle markets, not just from an upsize, but because they look more valuable in the fact that they're closer in price points. But C, the last thing to share, it also means that the price is rising in the lower quartile because it's closing the gap, which means it's growing better. And this isn't just a Melbourne thing. This is all over. Perth, Brisbane, the more affordable markets have been crushing it. So shout out to all the people who keep talking about the blue chip markets thinking that they're performing better over the last few years. Sorry, it's not true. And so if you think about that, one of the reasons has been interest rates forcing borrowing capacities down 30 to 40% and giving people no choice but to move their budget to other areas. And so that's what we're seeing as well when it comes to Melbourne. So the 3 locations I want to share with you where the lower quartile pricing is quite active is the suburb of Berwick, Craigieburn, and Pakenham. So this is towards the far north and the far east of Melbourne. And what we're clearly seeing is pressure is building up locally in the open homes. In these rings, we're seeing even 30 to 50 people attend in some open homes, which is a massive number for a city that on the macro trends does not show balance. Now, the key part here with macro trends is that CoreLogic, for example, may report Melbourne either declining or staying flat. But with the lower quartile, you're actually going to see the lower end of that market performing strong in some areas, but you won't actually see it in the city's trends. So if someone's saying I'm investing in Melbourne, looks great, and then you're looking at the CoreLogic data and it says flat or -1 or up 1, you're not going to see the trends that they're looking at that are examples of what's being seen in some of these suburbs. And so the pressure's being high, places are flying off in some key pockets for 1 or 2 open homes, and we're seeing that price pressure build, which is a sign of that lower trend or lower quartile trend improving drastically. Now, this isn't happening all over Melbourne. There's select pockets that are and select pockets that aren't. But the key here is that the lower quartile pricing trend is one to look out for in Melbourne, especially with those 3 suburbs that are showing increasing activity. So when it comes to the last data point, that's vacancy rates. So vacancy rates in isolation, again, are another data point that don't make the price market boom or bust, but they're important to know because you're holding an investment property and you're trying to rent it out. Now, these are what we call SA3 regions I'm going to point out, and they're called Wyndham Vale, Tarnay, and it could be Tarnate or Tarnay, whatever it is, and Truganina. And so these SA3 regions are seeing vacancy rates elevate a fair bit. So what you can see here is the balance line of 2% vacancy rates. And when I say what you can see, if you're tuning into the podcast and you're like, hey, I want to check out these charts, just jump onto the YouTube channel. It's InvestorKit, InvestorKit. I don't even know why I spelled it out, to be honest, because you're probably like knowing what it is listening to this right now. But I've always wanted to do that. So I guess you can always jump onto the YouTube page and check out this chart and you can see what we're seeing here as well. But vacancy rates in these 3 SA3 regions are surging over 2%, some even going up to upwards of 4%, and then some under 2%, but now near 3%. So these vacancy rates are impacting rental trends, and that's important to understand. So would the yields be healthy? Are these areas affordable? Yes. Are there areas within these sub-regions that are actually performing and growing and starting to see pressure build? Yes. But just be mindful that it might not be the 2 to 3 weeks to find a tenant. It could be 3 to 6 in some of these pockets. So you may have to decide which suburbs you'll completely blacklist and not go to, and then which suburbs you're comfortable with. But the key here is that some vacancy rate trends are important to look at, especially in the western parts of Melbourne, and that's something to consider. So that's 3 trends for Melbourne to really be mindful of when you're investing there. The first one is avoiding units. The second one here is lower quartile pricing and how that's really picking up. And you can use that particular trend in 2 ways. One is that, hey, I'm going to get great growth and I'm going to look at the lower quartile. Or 2 is you can go, why do I want to fight amongst it? I'll just be that 100K or 200K higher in price. It's eventually going to come to me. Interest rates coming down will make that happen as well. And same with the lower quartile just being too expensive. It'll be more valuable internally then. And you can be entering these markets without as much pressure and you can be in earlier, right? And that's kind of the 800K and above market. So that's the second one. And the third and final one is be really mindful of some vacancy rates in a few sub-regions of Melbourne, because it's not this smaller city where everything belongs to that one city in terms of its trends. There are divided areas of the city of Melbourne. And by the way, that's 5 suburbs or locations I've given you today as well that cover off where these trends are showing either good signs or bad signs, depending on those 3 data points. And that's it from the trends here in Melbourne. Now, if you're looking at these suburbs and going, hey, Arjun, that's really been helpful. I really want to have that data methodology on my side to get ahead with property investing. So I select the right areas of Melbourne if I'm looking to enter this market early in its cycle. Just reach out to my team at investorkit.com.au and they can have a free consultation with you to be able to understand if this market's the fit and how we can supercharge your portfolio.